so we're going to move into the next panel. But before we do that, I want to thank our members, thank our sponsors. Without your support, we wouldn't have been able to make this possible. And, many of the attendees wouldn't have benefited from the sharing of information that's gone on over the past 5 months rather. So again, thank you to all the sponsors, to all the members of FLIA. We very much appreciate the opportunity to do this. Tomorrow I'll be doing a presentation. If you haven't registered for my presentation, I suggest you do so. This series is a 5-part series, the winter and spring edition. Today and tomorrow will conclude part 5. In the fall, we'll be doing another 4 parts to the series to continue documenting what I believe is a once-in-a-lifetime macroeconomic event. The people here are basically writing the history. They're describing with regards to real estate, direct lending, private debt, what has happened, what has occurred, and how we're going to all come out of this. So I want to thank each and every speaker, each and every panelist for participating, and we're going to take the month of August off, but we'll be back strong every month, September, October, November, and December. So with that said, Michael Donofrio, are you with us?
Yeah, I'm here. Can you hear me okay?
Yes, I'm going to turn this over for Outlook for Private Credit in second half of 2020. Thank you very much for moderating this panel, and thank you to all the speakers that are here with us today. Please take over.
Excellent. Thanks, Michael and team. This has been a great presentation so far today. Would like to introduce my panel, and we'll get right to it. We're going to be talking about the outlook for private credit here in the second half of 2020. It's been an interesting first half. We've got some great panelists on the line with me as well today. And I see everyone else filing in. We got hundreds of participants on the line as well with us. So we got Nick and Rob and Bobby and Damien. I'll start off with myself. This is Mike Donofrio. I'm Managing Director with ETS, or Engineered Tax Services, based in Palm Beach, Florida. So where some of my background and expertise comes from. Really a specialist firm, very unique in the industry. We are kind of a hybrid between a licensed professional engineering firm that really focuses on just tax and cost and accounting and all the specialty credits and incentives and rebates that are out there at all different levels, federal, state, local. And it's very timely today. We're on our extended tax filing deadline day, 7/15, which is unique for our COVID year of 2020. So if you haven't done those cost segregation studies to maximize that bonus depreciation, that 100% bonus depreciation on purchases, looked at all the improvements and value added dispositions of stuff coming and going in and out of properties. That's the stuff we look at to maximize those depreciation and write-offs, those energy tax credits and incentives on properties. All of that stuff in the CARES Act was also amplified. Lighting, HVAC, roof, windows, all that kind of stuff also has some powerful tax credits that everyone forgets about. And just really understand that CARES Act. We're typically a specialist behind the scenes with small, medium, and very large CPA firms doing this kind of stuff, but we also work directly with many family offices, investment groups, private equity, individuals, high net worth, and just folks that might own properties up and down the streets, and all different asset classes we have expertise with. I know and have worked with many of our panelists today and others with FLIA. We've done some amazing presentations together, so looking forward to getting back together in person at some point soon. And if I can help you, again, we're based in Palm Beach, Florida, but we're a national firm, and I live in Charlotte, North Carolina. So if you happen to be in Charlotte or working on any properties or projects in the Carolinas, I'm happy to help you as well. So we'll get to our panelists. We have an excellent group today. We'll start with Bobby Werhane with Bellwether Enterprises. So Bobby, take some time, introduce yourself, let them know where you are, what you focus on, expertise. Sure. We'll go from there.
Sure, appreciate it, Mike. Thanks, and welcome everybody. My name is Bobby Werhane, and I work in Charlotte, which is our Southeast headquarters for Bellwether Enterprise. Bellwether Enterprise is a majority-owned subsidiary of Enterprise Community Partners, the nation's largest community impact investor. We at Bellwether are about an $8 billion commercial real estate bank. We like to call ourselves capital on a mission, and we provide full capital stack execution for our sponsors. I also happen to oversee our Opportunity Zone program here, of which we are on our second fund investing out of. Appreciate being part of it and looking forward to offering some insights into the private lending world that we're seeing today.
Okay, great. Thank you. It's great to have a fellow Charlottean on the line, and I know your firm's based out of Cleveland as well. That's where I was born and raised, but I think you guys do work nationally. Robert,
that's correct.
With Boomerang Capital, Robert, what's going on today? Where you at? What are you focused on?
So I am sitting in San Diego this time. The office is in Arizona, so I've escaped the heat. So Boomerang Capital is, we do hard money lending for mostly single family residential. Our exposures are concentrated in Arizona, Colorado, and Texas, but we're in about 24 states. Couple things that we do a little different than everybody else on the it's kind of all the way through the cycle. Thinking through origination, we actually do relationship lending rather than a number of our competitors are very active with on the internet, those sorts of things, SEO, SEM. We prefer to do relationship. We've had a little bit of an adjustment as we've moved away from some of the face-to-face meetings. We're all on Zoom and all those sorts of things now. The underwriting, one of the big differences there is we are committing our capital rather than somebody else's. A number of our competitors were dependent on secondary financing, that sort of stuff. It's our money. So people underwrite that sort of stuff. We say no to about 2/3 of what we see. Then positioning, we have a portfolio. A number of people don't really think about having a portfolio, but we never want to be all in one sector or all in one pace or all in one project life cycle. And then servicing for us has been a big deal. Most people or many of our competitors sell it off to a third party, have a third party servicer, those sorts of things. By staying in touch with our borrowers, we really have, it's been a competitive advantage. And then everybody asks, who cares? That's all great. So there's our fund return information, and love to take the opportunity to say welcome to a few of our new investors that have come from the FLIA platform. So that's who we are and what we do, and happy to have some of you on that are partners with us.
Excellent, thanks. And yeah, good news with the new investors and contacts met through this network. I've done the same, and that's why we're all here. Not our preferred Zoom format, but this is our new normal for the moment. But it's going well, so thanks again to the FLIA team. Nick, introduce yourself and give us some overview of KeyBridge and what you're working on. Where are you at today?
Hi, I'm actually in my condo in Century City, and there was a fire alert this morning. We had to all evacuate, and I just returned. I apologize. I'm just using my cell phone. We have no data on our computers yet. So
well, that's okay. Glad to hear everything's all right. Yeah, we can hear you okay.
Yeah, everything. It was just an alert. There was no fire. Thank God for that. I'm the president and CEO of KeyBridge Capital that manages a mortgage REIT. Our office has been in Beverly Hills for many years. I've been in the real estate business for more than 25 years as a lender So I've seen a few cycles. This one is very different. But what we do is we are in the bridge lending. We provide a 1 to 2 year term, no more than 50% secured by select property types, commercial property types. And our market is California. Our primary market is the coastal counties of California.
Okay, great. Thank you. Damien,
Sure.
are you international today, or where are you at? Tell us a little about your firm.
It's a relevant question in my life for the last years. Thank you, Mike. I'm actually in Miami now. Even though our company is in New York, I'm based in Miami, and I am about to travel this weekend again. But
I figured you might be going somewhere. You're all around the globe.
yes, that's been, well, I have to say that this crisis, a huge price to pay, but the upside was that I was able to prove to my partners that so much traveling is not really necessary. Not that good for the airlines, I guess, but yeah. But briefly, as our story, we started off in '96 as a multifamily office. We still are. We're based in New York. One of the first multifamily offices focused 100% in non-US investors. Basically, our investors are families from Latin America and Europe. They're still with us, still today. That's our legacy business. But in 2004, because of our core investors plus investors communities from and relationships from these regions, LATAM and Europe, they came to us asking for alternatives, illiquid direct investments opportunities in the US. We created, therefore, in 2004, a alternative investment platform, which is Confidus Capital. And it has been a great history since. We've completed over 2.2 billion of transactions, always for non-US investors. We've done a lot of real estate, but in the last 4.5 years, we really focused in real estate debt. There was and there is a strong demand from foreign investors in this asset class. And we really focused on it, and it has been the predominant part of our business in the alternative platform. So I can bring to this conference a little bit of the perspective of the foreign investor in U.S. Commercial real estate debt.
Excellent. Thanks. Well, it seems like we have the geography of the U.S. covered today on our call, from Miami to Beverly Hills and San Diego, and two guys here in Charlotte as well, and pretty diverse group, servicing different investors, different assets, different strategies. Perhaps there's some ways for us all to work together as well. So back to Bobby. Bobby with Bellwether, and I know the firm's pretty unique as well. You might want to expand on that a little bit, because there might be some related offerings of what you guys do besides just this focus. But just overall, what strategies are you focusing on, with the current environment? I mean, the stock market is up, and then it's down big, and then it's V-shaped recovery maybe, and then it's down, and then it's up, but all our clients are continuously focused on real estate. Of all different types. What are you guys seeing out there, and how are you recommending capitalizing on it?
Right, Mike. Well, thank you for offering the opportunity to expound on Bellwether Enterprise as a whole. I'll start off with this little bit of anecdote. A very long-time friend of mine who's been quite successful. Oftentimes, he and I try to pick stocks together, and not that long ago, he asked me what I thought about Tesla, and I told him that it's the single largest shorted stock in the country, and I think he should sell it. Needless to say, he sent me the middle finger emoji the other day and said, "I appreciate selling it at 400. It was at 1,600." So I'm thankful we're focusing on commercial real estate assets today and not on the stock market. I have no idea other than to say that I think there is some carryover into the commercial real estate world, and that we're all still functioning a little bit on the sugar high that the federal government has provided the economy in Main Street America as a whole. I am happy to say, what we're seeing kind of nationally across our platform. As you mentioned, we are a national firm. We are a pure play middle market capital provider. So, we usually play in the $100 million projects or less. And therefore, we're seeing kind of the secondary and tertiary markets. Yes, we have offices in New York, LA, and some of the larger areas, but we see middle America and what's kind of going on there. I think it's very interesting to note, though, that because of where interest rates have been held, that we're seeing, and because of where interest rates are being held, and frankly, where I think everybody believes they're going to be for at least the next 18 to 24 months, which is incredibly low, we've had this market being propped up from a value perspective, and therefore we're seeing an incredible inflow of folks into the debt markets in order to refinance their property. So where if you were to have someone talk about where the kind of investment sales world is these days, I'm not sure there's a lot going on there, but in terms of the debt markets, the debt capital markets, capital is flowing, which is a major difference of where things were in 2007, 2008. And frankly, even 6 weeks ago, where the markets were a little bit frozen. So I'm happy to say that the capital is still flowing to good projects. Good real estate is going to get financed, and we're seeing, as I mentioned, interest rates probably being propped low, staying down artificially, at least for the time being. As an example, I think it always makes sense to talk about examples. As an example, we rate locked a deal through a HUD product, through our HUD platform, their 223F platform, that was at 258 on 80% leverage. Difficult for private capital to compete with that, but what we're seeing is a lot of private capital providers be able to slide into the role that more conservative capital providers were in and receive some yield there. And so further to the low interest rate point, I think it is worth bringing up that the private equity markets, meaning the joint venture private equity markets, are still undergoing, at least what we're seeing, a ton of price value discovery in the market across every asset class. Although I would say multifamily and industrial are probably the most financeable asset class still, and they were going in pre-COVID and certainly are now. So
really, that's really what's going on. Our borrowers, there's a huge need for homes to be rehabbed. Average age is 34, 35 years. So there's a lot of housing stock that's old and dated, needs to be refreshed. People want it refreshed. People are willing to pay much more in line with prices for a refreshed home. And so that's still going, and our market is kind of coming back to normal, although probably about 10% of our competitors will not be coming back.
Okay, got it. And Nick, and Robert, thanks for that. Sorry, I'm just kind of keep it moving through everybody. And Nick, your version of what's going on in the current landscape. I mean, is stuff being held up with loan requests, or are you seeing problems, or are they getting sorted out? What are you seeing out there?
Well, 2019, we were predicting a correction and adjustment in the market. No one ever knew that it's going to be to this extent. Like my colleagues, we did take a little pause. We wanted to reevaluate the market, and the changes we've seen and we've made is that we're now very selective on what asset class we're interested in lending and what location. Location is hugely important. We lend our own money. We're not selling. We've never sold in the secondary market. And so all the decisions are made in office, and it's pretty simple. If you like the location, one of the reasons we are in California is a state that I'm very familiar with, and so we can make very quick decisions. When a property comes to us and borrower needs money, we can evaluate the type of the property, the strength of the borrower, and what changed really is, there's a lot of what-if scenarios now, into underwriting that we didn't. What if the borrower is not able to pay us off in 1 year when our loan is due? So we're taking a look at each and every loan request very carefully. That's really what's changed. We're busier than, I want to say, pre-COVID, because we're getting a lot of loan requests. As you all know, banks are making it very difficult to lend. In fact, Wells Fargo just this week, I think, or last week, announced that if anybody, and that's on the residential side, we are not a residential. We don't lend on homes unless they're purely investments, and we don't like to make loans less than $1 million. Really, our market is, we like the $5 to $15 to $20 million size deals as a bridge lender. Although we're capable of making larger loans. Wells Fargo decided that if you apply for a mortgage on your home and it's jumbo, meaning I think it's above $750,000 limit, you have to bring in $1 million cash into Wells Fargo. They're essentially saying, we just don't want to make those loans because not many people are capable of bringing $1 million liquid assets into the bank.
Mm-hmm.
So a lot of changes
Wow.
we're seeing. We've always been conservative. This time we're more conservative, I want to say.
Okay. Damien, how about you? What impact is the current environment having with especially with your foreign investors and what they're looking at or looking for, within the U.S. commercial real estate markets and debt markets specifically, if appropriate?
Yeah. Well, first of all, let me just explain that we are on the investment side, so we don't underwrite ourselves. We rely on lenders that we work with to do the underwriting, and obviously there's a relation of trust, and we oversee our investments as a portfolio manager for our investors. We've talked to many different lenders. We have a relationship with a group. Some of them were very active. And what we see on the investor's perspective is that we did expect some distress coming in, more opportunities on distress. That hasn't really come to fruition. We were expected, maybe because of trying to look with the lenses of 2008-09. This hasn't happened so far, not at least with the lenders that we work with. We were very fortunate that the portfolio was most heavily our portfolio was mostly on senior debt and the multifamily sector. So that offered us, and with a good conservative LTV, that offered us some protection, even though we do work with different asset classes, types of loans and geographies across the country. There has been some delays because of work stoppage and different situations, but no delinquency so far. So we're happy.
Good news.
Yeah, for us, yeah, definitely. For the foreign investor, and again, I talk to them weekly. There's quite a sizable number that we work with. They see as an asset class that has proven some resilience in this crisis, naturally, because there was a very careful curation and selection process. But they see it as an asset, and we're very optimistic that going forward there will be more interest from these foreign markets. Naturally, we'd rely on the deal flow coming in. And obviously we're talking with our lenders and what they see, and also bringing back to what was discussed before, there has been a dry out of players that relied on leverage. Basically, there was a lot of competition before that got us very concerned. The rates were coming down, LTVs going up. This in a way has been filtered because of the crisis. So really the lenders that remain are the ones that have balance sheet capacity, history, and to be able to close and select the good loans. So we see a good pipeline coming in through the lenders that we work with lower LTV. Some of them are buying loans from other players that just didn't have anymore the leverage to keep up with the obligations because of margin calls and so on. So we see in a portfolio going forward approximately same rates as we saw it before, but a lower LTVs, meaning a lower risk.
Got it. Thanks for that. Bobby, I'm going to jump back to you and picked up where we left off on different asset classes. You had mentioned the stock market and everyone wants to buy low and sell high. I always end up doing it the other way around for some reason. And I know you have a background in hotels and hospitality. Is it an opportunity for investment strategies there in the hospitality sector, or are you holding off? And then part two of that question is what else are you focusing on? I know you're heavy multifamily and workforce housing and affordable, but what's going on with hotels right now?
Well, I actually, and I'm sure most of the folks on this call have had the luxury of listening to the presentation that was prior to us, and I did the same. I always try to keep an eye on hospitality, but just to find out where the kind of market is heading. That is, at least from a financeability standpoint, just about a red line asset class that we're seeing a ton of price discovery still needing to go on, still needing to see both ADR and occupancy kind of propped up a little bit more. I would tell you that in retail are and probably retail more so than hospitality are the most scrutinized two asset classes that are out there right now. I know that's I'm not saying anything that most folks don't know. There will be some opportunistic either acquisitions or just basis resets on some of these deals. As a matter of point, not to switch into retail, but hospitality obviously is very closely related to some retail as well. As an example, on the retail side of things, Brookfield owns about 170 malls nationwide, and out of that 170 malls that they own, roughly 70 of them are impaired in some way, shape, or form, and 40 of them probably aren't worth the paper that is on them. So when you have major players like Brookfield still trying to figure out how they're going to value assets and the lenders that are for them, I think it speaks volumes to where people think the market's going to be. I was on a call. I was on a large conference call with Barry Sternlicht, who mentioned that he does not believe that, and this is across their entire portfolio, that occupancies will come back to pre-COVID rates for at least 24 months. So I would tell you that there's still a ton of skepticism there. And frankly, I don't think the other shoe's dropped yet with regard to, that industry needing a further federal assistance. And hopefully we figure that out and that industry comes back sooner rather than later.
Mm-hmm. Yeah, I agree. I don't know if my business travel is going to get back to where it was anytime soon, from what I'm hearing from a lot of clients. Robert, you can stick on that asset class question, and I know you focus on single family, residential and maybe some small multifamily. Are you seeing impact to those types of asset classes in terms of the government deferral and forbearance programs that are out there, or what are you experiencing?
Yeah, so we do business purpose loans. We do not do consumer loans. So the government programs that are focused on mortgage with forbearance and restructuring and any of those sorts of things, that it doesn't apply to us. Ours are business purpose loans, so we never really experienced that. Had to go through that that exercise. As far as what we're seeing we're definitely seeing the flow out of urban into the suburban and those sorts of things. And we thought it would. We when we first started looking at this, we thought into the pandemic and things, we thought that there would be a much longer lived impact, and we've been very surprised that it's been so short-lived, and so the impact has really been pretty minimal. And I'm sure this. We all do real estate, so I'm not saying anything, but I think it's worth putting on the table. It's very local. Real estate is location, location, location. So if we're talking about what's going on in Texas, it's a little, it's different than what's going on in Colorado or Arizona. Very different than what we see going on in Ohio. Very different than what we see going on in New Jersey. So, and even if we go state by state like that, you know, I can tell you a project that's going really well in a state, and you know, one town over, I've got a project that's not doing so well. So, you know, the location's really important.
Yeah, I agree. I mean, even within certain asset classes, I mean, Bobby mentioned retail, and yeah, there's certain types of retail is horrible right now, but I got a bunch of clients and we're working on a lot of projects with, you know, small strip center type locations that are very hot, you know, for certain types of retail. And industrial and distribution and, you know, flex office is very hot right now as well. But thanks for that. Nick, I saw a note that, I mean, I guess because maybe some of these more difficult or challenging assets, is there more seller financing that's popping up? You with us, Nick? Are you on
Typically do
on
so.
mute? Go ahead.
I'm sorry, can you all hear me?
I can hear you now.
Can you hear me? Okay, great.
Yes, sir.
Sellers typically do not want to finance their own property. They typically do that out of necessity. Bridge lending can, you know, elevate the burden on sellers and free up their capital for an exchange or just straight cash out. You know, this environment opens up more opportunities for bridge lenders to source purchase transactions where, you know, new cash equity is put in front of the bridge lender loans. So my answer is, you know, sellers, we've seen that. The sellers do that if there's no other option. But I don't think that's really going to slow us down with our loan request. And I also want to add that even though we've been very busy with loan transactions, I agree with one of my colleagues who says he declines 2/3 of their loan requests. We're doing the same thing. About 2/3 of our loan requests are being declined. In regard to hotel, I just want to add, if I may, really quickly, it's an asset class we were never familiar with and we stayed away from.
Got it. Damien, what's the key factor in someone, you know, switching or transitioning from investing in real estate equity to investing in the debt? I mean, that's a big leap for some. What's the key factors there?
Yeah, that's why it took them so long. It was a very slow process. I mean, we've been doing real estate. Confidence, the first deal we did was in 2001, and all of it was equity. There are many factors involved. It was a very slow process. I can tell you that about 4, maybe 3 years ago, I spent most of my time traveling to Europe and Latin America explaining what commercial real estate, transitional loans or bridge loans are. Exactly this middle market space where there's certain inefficiencies and high fragmentation of the market. So it took them a while. It has not substituted the equity portion of their portfolio at all, but it has added to a kind of a hybrid instrument where they are able to get short-term returns on a very good cash-on-cash yield, but backed by commercial real estate. So it started up like an alternatives income strategy, and it's slowly now taking over part of their equity portfolio as well. Obviously, there are nuances between Latin America and Europe, and even within, obviously, between Europe and Latin America types of investors. But then, in general, that's the main key factors. Today, what we see is that there will be a growth in interest in debt. We see big wealth and multifamily offices in these regions coming to us and discussing how we can do things together. So we foresee that there should be a growth in the interest from foreign investors in real estate debt, especially because it's now clear for them. Obviously, before they always ask me what was the stress case scenario, and how we tell them, here you are. Nothing could be more stressful than what we're going through. And the fact that we've been navigating reasonably well proves that it is an asset class that has a great future for foreign investors. Taxation issues are also a big point. This is appropriately structured is a tax. There's usually no tax leakage for foreign investors.
Yeah, great point there on the tax portion of it. I mean, that's our business as well. I mean, typically our investors in our own family office is investing in properties for that, that depreciation, that 100% bonus, doing that cost aggregation study, getting the energy tax credits. Almost none of that would apply to your foreign investors, which maybe is a great reason to transition to the debt side of things. So it's a great point. And again, if I can help anyone on some of those tax credits, that's what we do. Bobby, jumping back to you, and actually I saw a question come in from the audience, which I know Jeremy, Michael, and team always like that I pay attention to that stuff, from an Andrea. She said, speaking of skepticism, how do some in the industry, and I think she's talking about hospitality and travel, arrive at these numbers of when the travel and business comes back? I wish some would back up with data analysis. Otherwise, it just seems like speculation. Do you have any feedback of where or how they're getting their information on that's the hospitality and travel question of where that data might come from? I'm assuming maybe they're tracking, the business travelers are looking at points utilization. They're looking at, I don't know. Do you have any feedback for that?
Yeah, so the question's a little bit ambiguous, but I'm happy to take a stab at at least some of the stuff that we track, and that's just kind of industry stuff. So
Yeah, exactly.
obviously we stay in touch with the folks at CoStar and the folks at Reis, and use all of the standard industry resources. The other folks that we actually really pool a lot of, other than our own internal folks, are the tenants tenants that live in our buildings. One thing that I did not address in your last question, which was kind of how this overlaid into the multifamily / workforce side of things. So we have, Bellwether Enterprise has our own proprietary data pooling system, where we actually are in connection with our we own about 1,400 multifamily units nationwide, which equates to roughly 14,000 units. And you can kind of extrapolate how many tenants that we have. And through our direct lending and investing platforms, we invest, roughly $500 to $600 million of our own private equity capital into projects, and that levers up pretty quickly as well. So we like to say that we use our own sources of data that are folks that report directly to us, whether they be our tenants or whether they be our customers that we're financing projects through. I won't speculate as to where Barry Sternlicht got his information, except to say that Starwood Capital is, as most people know, one of the more well-respected hotel REITs nationally. The other thing too that I thought would be interesting to touch base on is our servicing portfolio is roughly $28 billion, and so and that's spread across, we're full Freddie, Fannie, DUS direct lender, and a HUD MAP lender, and so it's kind of spread across, and we've got 70 different life company relationships and direct bank relationships and so on. We are constantly internally here pooling our borrowers and our forward-looking potential customers, sponsors. So we aggregate all of that data here internally, and then we spit that out and try to do our best to kind of read the tea leaves, which way the wind is blowing. I know that's very difficult sometimes, but I would say that I actually just was on a call today with the head of our servicing group, and across that $28 billion, only about 35 basis points of loans are in, kind of special servicing or trouble. So to one of my colleagues' points, I don't think we've seen the type of drop that most people were thinking was going to happen. Obviously, look, the real test of time will be, what happens here as the PPP money runs out, and are people still going to pay rent or not, in August and in September? We'll see. But I would say that generally speaking, it's been a much softer landing. And, I think folks are hopeful that that continues through, through the fall. But there's just so much unknown that, it is a little bit scary.
Yeah, great information. Appreciate that. And Robert, are you seeing differences between your urban and suburban markets with projects?
Yeah, we're just seeing the flow, kind of out of urban and into suburban. People, you can kind of read the newspapers and think about some of those sorts of reasons, but nobody wants to, it's the commute and it's the hassle and it's the costs and all of those sorts of things. And people really want to control their own space. If you look at the multifamily, people are, and multifamily is so big and there's so many people involved that I don't think it really dents multifamily that much, but it definitely is a good flow into the suburban. And you've seen, we talked about it, a while ago, but like a year or so ago, but the millennials are actually showing up now and purchasing their homes. So that's kind of what we're seeing there. The other thing, just to the question before, if you get a little skeptical on, things, you can look at the publicly traded REITs. There's a handful of them in the lodging, which is hospitality. And you can see what the prices are doing there and get at least, I would rather have the non-public information than the public information almost, but it is another source of a significant number.
Get out.
Cool. Well, hey, the background noise is all part of us working from home these days.
Exactly. All good.
It's all good. But whoever that was better get down from there. They're going to get it. But yeah, thanks for that information. And I agree. I'm seeing the same things of outflows of. I can't tell anyone else where we live in Charlotte because everyone from New York and New Jersey and everywhere else that we talk with is coming out of major cities. I mean, we track some of the major outflows of the New Yorks, the LAs, the Chicagos, a lot of these Clevelands. I mean, they have a net migration of folks out of them. I think it's going to continue, and even millennials that I think enjoyed living in some cities now are finding the reason that folks were finding themselves in suburbs as they get a little bit older. So, but yeah, great points there.
You see this
Damien,
question.
Yeah,
Oh,
go ahead, Nick.
You see this question on, tertiary cities. We are not seeing it into tertiary cities. People still want the services. People still want good internet. People still want access to good restaurants. So we're not seeing it into the tertiary stuff.
Mm-hmm. I agree with you, except if I see some certain tertiary cities where businesses or companies have relocated or there's a reason for that tertiary city to grow, but just to move there, I don't see that happen. It's really jobs is always the driver that we're seeing.
Agreed.
Damien, in terms of geography, is that a factor of where you're looking at investments, or is it really the deal that is the underwriter for you?
Geography, not as much. Obviously, we trust the lenders to be able to pinpoint the good locations. Asset class, definitely. And the types of loan, obviously, that is the key factor, how we determine the balancing of the portfolio between the different investors. On the asset class level, we don't go as deep into determining whether it's urban, suburban, but more on a generalistic type of class. I would say that our preference going forward is multifamily, of course, the grand majority. That should remain for the foreseeable future. Some mixed use where there's a component of convenience retail, that's well accepted, and industrial and logistic, of course, even though what we have seen, there's it's a very competitive environment and more difficult for the lenders to play in. Some student living, yes, very specific, and independent living, yeah, especially the ones which, I mean, it costs them less because they don't use the school, so there's a certain advantage for the renters in the independent living. We don't do any senior living or health, any kind of asset which requires a license to operate. We just don't want to be in a situation where invested and there's a foreclosure and then we are not able to take, I mean, not us, but the lender to take the asset forward and operate it and stabilize or sell it. Hospitality, definitely it's not clear for us. So, and the types of loans, it will be a heavy overweight in senior loans. We do some B notes, we do some mezz, and we do some bridge to agency as well. But I would say that senior loans and bridge to agency will be our preference for at least the next 12 months.
Got it. Bobby, back to you. Are there any federal-backed plans you think should be enacted to assist the private credit markets?
Thanks, Mike, for bringing that up. That's a good question, and I think it absolutely bears more exploration. That, to me, ties directly into the availability of capital in the markets. The amount of qualitative easing that's occurred to date and the fact that interest rates are essentially zero has allowed there to be a ton of liquidity in the market. The problem, like 07, 08, was, you know, there's the liquidity issue and then there's the willingness to lend issue. And so one of my colleagues before brought up the lack of kind of secondary CLO type lenders that basically were toast in the 6 or 8 weeks ago, where their line lenders were kind of doing their mark to market stuff or margin calling them, and they had to sell those off, and some of that stuff is still clearing through. To the best of my knowledge, that market is opened back up again, not to the extent that it was before, but if there is any prolonged market if the market seizes up for any prolonged period of time, it's going to require, in my humble opinion, the federal government to step in and provide liquidity again to some of those lending institutions or some of those markets. But to the extent that cash is still flowing and is available and it's still going out the door, I think you'll see. I don't think you'll see the necessity for federal government to step in. The other major factor are the GSEs who have been providing liquidity and have been lending at record pace throughout, basically lending all throughout this crisis. So, folks that need liquidity for more conservative assets have been able to get them at historically low rates. It's the folks on the fringe, the private capital folks, that have to be a little bit careful. And I think one of my colleagues mentioned earlier that as that stuff seizes up, I mean, at one point in time we were tracking over 250 different private lending institutions, alternative asset lenders. I would be surprised if we don't come out of this thing next year with at least a third less of them, or at least some of them changing names, because they're kind of your traditional warehouse lending type folks. So if the market sees up again, I do see the necessity for some sort of federally sponsored program to make sure that liquidity is kept flowing.
Understood. Yeah, it seems like the administration has been pretty proactive and wanting to keep providing assistance and liquidity wherever happens. I mean, they did it before. I'm of the opinion they'll do it again pretty quickly, and I'm hearing those PPP loans and other programs and other government assistance is going to be reenacted within the next week or so again. So that's just a personal opinion. Robert, speaking of secondary markets, what are you seeing in the secondary markets for debt?
So we don't sell into the secondary markets. We are it drives the competitive landscape is what it does, is because, you know, you've got the warehouse lines or the people who are really just brokers. So the secondary markets do definitely seem to be back. We're seeing competitors that were not there 6 weeks ago. They disappeared, and they're coming back. So the secondary markets are back. I don't know how. I think they'll stay relatively healthy for a while.
Got it. And Nick, we got to about 5 minutes left, so we'll get through a couple more questions, and then we'll do a quick once through. Any important borrower experiences versus property fundamentals in this market that you'd like to talk about?
Well, borrower experience has always been a criteria for lenders. In the new era, in this era, a borrower experience takes on a much broader dimension. How creative can a borrower be in finding solutions to new challenges? Collecting a monthly check in a triple net retail center, or occasionally dealing with a property maintenance issue or eviction in multifamily was the norm for many commercial property owners. Now, if the property does not stay on a relatively self-sufficient course, property owners will be facing with a much broader array of challenges to navigate. Those borrowers that can meet that challenge are critical going forward.
Yeah, I agree that experience is important. Damien, we'll start off with you. In closing, all the folks that are on the line with us and will listen to the recording of this down the road, what's the reminder of why they need to contact you? You know, what's your expertise, and you know, what is the strategy that they need to remember?
I think that we were able to understand and translate this huge, reasonably inefficient and fragmented market, which is the middle market bridge lending, basically loans between 12 and 36 months and a size between 10 and 100 million. That's a market that was very unexplored and not even acknowledged or understood by foreign investors. So through the years, we were able to understand, translate, pinpoint, select the partners that we were comfortable working with. We're expanding our network. So for the foreign investor, it's a great entry point into this asset class, which is huge in the US, and it's quite large in Europe as well. And but we're focused on the US market, commercial real estate.
Got it. Yeah, I agree. It's very, very unique, and look forward to seeing you down in Miami soon. So thanks for your participation today. Bobby, same thing in closing. What should folks, what's their takeaway? What type of project should they be calling you about?
Mike, thanks for the opportunity to join your panel and also talk a little bit about our company. So I would say this, that certainly we aren't the only ones that provide the set of services and skill set that we do. I would say some of the competitive advantages that we have over our competition is that, you know, we have both direct lending capabilities. So we have on-balance sheet private equity and private debt sources, as well as intermediary sources and proprietary GSE sources. So to the extent, you know, so we truly are a full capital stack advisor and create a, you know, competitive environment. And many times we compete against ourselves on deals so that we get the best execution for our client. You know, the other piece is that, you know, we are a you know, mission-based capital. So, you know, many of our projects have some sort of ESA that's either environmental or sustainable or affordability component to it. So, you know, just by de facto, we understand markets that are traditionally more difficult to invest in or more difficult to understand. So if you truly need assistance regarding full capital stack advisory, you know, we'd love to talk to you.
Excellent. Thanks, Bobby. And Robert, quickly, what's the closing reminder of folks where you can help?
For us on the investor side, we've been doing it a long time. It's a bunch of our money. We're easy to understand. If anything, we're kind of boring. So if we can be helpful to you there, love to help.
Got it. Thank you. Nick, you want to close it out?
Yes, thank you so much for the opportunity. Thank you again for the opportunity to be on your panel. On the lending side, pretty straightforward. If there's a property that is in a good location, we'd be interested in looking at it. If it truly meets our underwriting guidelines, which is very much straightforward. We're an equity lender. We don't really like to go more than 50% loan to value. Value is very important now. It's more challenging than ever before what the value is going to be a year from now. We are optimistic, but we're taking a very conservative approach in every underwriting. We're preparing for the worst and hope for the best. We think there's going to be more problems in the near future. Even when the Fed says for the very first time they'll do whatever it takes, and the market has confidence in the Fed to step up if it's needed to pour more money into the market. But we're going to see, I think, having a few cycles, that this is going to be a little difficult and the road ahead is going to be very bumpy. So as such, on the investment side, for lending side, in the investment side, pretty straightforward. We are a mortgage REIT. We provide audited statements to our members, investors. They have to be accredited, monthly distributions to investors. We're treating the company as if it's a publicly traded company with full transparency and audited statements, except we don't want to be publicly traded. And thank you again for the opportunity.
And thank you, and look forward to catching up for lunch and dinner in Beverly Hills soon. And thanks to all of our.
I look forward to it.
Yeah, man. And so thanks to the rest of the panel and our audience today. Again, this is Mike Donofrio with ETS, Engineered Tax Services. If I can help with those, specialty tax situations, the cost seg studies, the energy credits, the opportunity zones, the structuring, the solar and specialty alternative investments to not pay any more than we need to. That's where I can help. So, Jeremy, Michael, back to you. Thanks for a great panel.
Hey, thank you very much, Michael. Thank you to all the speakers. We really appreciate you guys coming and speaking to the audience today.